So once again, good morning all of you and welcome back to another video. So in this video, we are going to learn about different types of financial market along with the equity share, what is preference share, such kind of terms we are going to look after. Okay, so my name is Priyanka Mahanta, Assistant Professor of Business Administration Department, USTM. So let's begin our today's video. So first of all, what is a secondary market? Now, in the last video, we already have discussed what is a primary market, right? What is a primary market? You can see in this diagram or in this picture, the first part, okay? Here it's written as X, Y, Z, INC, okay? Now, this company is selling their shares, okay? And here, this girl or the investor A is purchasing it, okay? So she is purchasing it directly from the company itself. So primary market means what? Primary market means when the company is issuing the shares for the very first time in the market. Okay, that means company, maybe the company is new or they want to get listed. So before getting listed, they make their shares available to the public through IPO, which is in what to say, initial public offering. Okay, so through IPO, companies provide their share and make it available to the share like investors, to the public. Okay, now in the other part of the image you can see that suppose this investor A have purchased the shares of XYZ company. Now she wants to sell it off after 1 month. So where she is going to sell it? Will she sell it back again to the company? No, it's not possible that she will sell it back again to the company. Okay, so she needs a marketplace where she can sell her shares. Okay, so that another investor, which is investor B, can purchase it. Okay, so here when the company share becomes kind of second hand, okay, one has already purchased, now it's in the market, now I want to sell it again because I think that it will give me more profit or something like that. So investor A is going to sell the shares in the secondary market where another interested investors like this investor B can purchase the share of XYZ company from her, from investor A. So I hope we can understand the difference between primary and the secondary market. So in primary market, directly from the company, we get the share. But once we get the share, if I want to sell it off, I need to sell it off in the secondary market, or we can say in short the second hand market, okay, which is a place for buying and selling of all the shares of the company, right? Now, what is secondary market? So, secondary market is a platform wherein the shares of companies are traded among investors. So, it means that investors can freely buy and sell shares without the intervention of the issuing company. So here, whoever was the company here, in our example, it was XYZ company. Okay, so once the company has sold out the share, it's none of the business of the company whether I am keeping the share or selling it off. It's up to the investor who has purchased it, right? So there, the XYZ company has no right to say over there ki don't sell it or something like that. Okay, it's totally up to the investor who has purchased the share. If he or she wants to sell the share or buy some more share, it's up to him. Okay, the company cannot intervene over there. So in this transaction among investor, the issuing company does not participate in income generation and share valuation is rather based on its performance in the market. So now uh, let's understand the structure or how this stock market things happen. Okay, before there was not such kind of platform, okay, where we all can see whether the stock price is going up or down, how I can decide whether I need to sell it or whether I need to purchase it. Okay, so but now this facility is there. Okay, by sitting at home, there are various apps related to share market like the Grow app or Zerodha. Okay, there we need to make our demat account. Okay, that means dematerialized account. And when we make the account and when we sign into that platform, it will give us the glimpse how the stock market is working. Okay, we have two main exchanges. One is NSE, which is known as National Stock Exchange, and another one is BSE, which is Bombay Stock Exchange. So here they have different kind of indices into it. Suppose NSE has some kind of only indices like the Bank Nifty. Bank Nifty means all the banks. Okay, top 50 banks are there over in the indices. Okay, so how these are performing? Okay, how these banks are performing? Now you need to remember this. For NSE, the main indices is Nifty. Okay, and for BSE, the main indices is Sensex. Okay, in NSE, under NSE, the Nifty has total 50 top companies over there. Okay, and when we talk about the BSE Sensex part, they have 30 top companies over there. Okay, so you have to remember this thing. NSE, they have Nifty and there are 50 companies. BSE, they have Sensex and they have 30 companies listed. So now here how it works. Suppose for example, let's take the example of Reliance company. Now Reliance company, when they came into the market, maybe the share price of one share of Reliance company was around, maybe suppose 500, just an example. But now as there is more demand in the market, people are more aware about Reliance, they have a goodwill in the environment, people know that Reliance company is doing well, so all are willing to purchase the share of Reliance. Okay, so when they are purchasing the share of Reliance, ultimately this demand of Reliance share has increased. So when it increases, the demand increases, the price of the share goes up. Okay, according to the demand, the price of the share goes up. If it was in 500, maybe due to lots of demand and there was no more supply, maybe the share price of that Reliance company has reached to 1000 or 1500. So this is how it works. If the demand decreases, then definitely the price will go down. Okay, so it is based on the performance of the market, how the share of that particular company is participating in the market. Okay, so income in this market is generally generated via the sale of shares from one investor to another. So how you can earn money? Like I said, suppose I purchased the Reliance share before at 500 rupees itself. Okay, at 500 rupees one share, and I purchased suppose two shares. So total how much? It's 1000, right? Now as I saw the price of the Reliance share went up to 1000 rupees, okay, per share. Then I decided कि I'm going to earn 1000 rupees extra because I have two shares which I have purchased at 500 only. Okay, 500 each. But now I can get extra 500 because the price of the share in the market is 1000. So I'm going to sell it off. So when I'm selling two shares of Reliance company in the market, when the price of the share is 1000 rupees, then I'm going to earn how much? I'm going to earn 1000 rupees extra. So that is my income. So this is how the investors earn by buying and selling of the shares in the secondary market. Okay. So see here some of the entities that are functional in a secondary market. So what are the main entities over there? First one is retail investors. Second one is advisory, service provider and brokers. comprising commission brokers and security dealers. Next one is financial intermediaries, including non-banking financial companies, insurance companies, banks, and mutual funds. Okay. Next one, functions of stock exchange, or we can say as the secondary market. So we will just look after these functions one by one. So first one is economic barometer. Okay, so it is a reliable barometer to measure the economic condition of the country. Okay, the rise and fall in the share price indicates the boom or recession cycle of the economy. You know what is boom? That means the economy is growing upwards. Okay, there is more money in the economy. But when we talk about recession, that means it's going down. Going down means money in the environment or in the economy is going down. It's the time of recession. So with the help of the secondary market, we can determine the economic environment of our country. Okay. Next one, pricing of securities. So the stock market helps to value the securities on the basis of demand and supply factors. So as I told you, the price of the shares in the market depends upon the demand and the supply. If the demand is more and supply is less, definitely the price will go up. And if there is no demand and the supply is more, the price of the share will go down. Okay, it depends upon the demand and supply, what will be the price of that particular share. Next one, safety of transaction. So whenever you are doing transactions over stock exchange, okay, like the NSE or BSE, so these things are organized, right? Organized, and they are being guided by SEBI. Okay, the SEBI is the one who looks over the all the functions of the stock exchange. So it is safe for us to do transactions over there, okay, instead of unorganized manner. So in stock market, only the listed companies are traded, and stock exchange authorities include the company's name in the trade list only after verifying the soundness of the company. Until and unless they can prove that this company is really sound in financial position and they are doing well in the business, they cannot be listed in the stock exchange. Once only they satisfy them that it is doing well, the financial position of the company is really good, then only they are listed in the stock exchange. So it is beneficial for us, for our safety, because we are not investing in those companies which are new, or we don't know the financial performance, whether they are good or not. Okay, so they check these things beforehand itself, before listing the company in the stock market. Okay, next one, contributes to economic growth. So in stock exchange, securities of various companies are bought and sold. We all know that, right? So this process of disinvestment and reinvestment. Disinvestment means if I'm selling it off. Reinvestment means when I'm purchasing it again. Okay. Disinvestment and reinvestment helps to invest in most productive investment proposal, and it leads to capital. So ultimately, when it leads to capital or revenue, ultimately it contributes to the economic growth of the country. Okay. Next one, spreading of equity cult. So stock exchange encourages people to invest in ownership securities by regulating new issue, better trading practices, and educating public about investment. So it's better for us also, because we are investing in our money, because we can get lots of profit out of it. But we should be aware enough how this mechanism works, how this market works. So until and unless we are aware about it, even if we are in the market, we will be just kicked out of it because we don't know where to invest. Okay, so we should be careful before we invest our money in the share market. Next one, providing scope for speculation. So to ensure liquidity and demand of supply of securities, the stock exchange permits healthy speculation of securities. Okay. Next one is liquidity. So the main part is that if I have purchased it, at some point of time I may want to sell it off. Okay, and I want the money immediately. So where is it possible? It is possible only at this market, only at this stock exchange over there. Okay, I'm selling the share and someone purchases it. Within 1 day or 2 working days, we are going to get the money in our account. So it provides the liquidity over there. Okay. Next one, better allocation of capital. So it better allocation of capital in the sense that it promotes a kind of habit of saving among the investors, right? Because once we put our money over there and we get some kind of return out of it, it will encourage us to invest more and we can get more return out of it. See here, we can see capital market instrument. Okay, ownership security or capital stock, creditorship security or debt capital. So here, when we are talking about the ownership securities, we are talking about the equity share, the preference share, and the deferred share. But mainly we talk about the equity share and preference share. And when we are talking about the debt capital, we are talking about the debenture. Okay, so you have to remember these things. Ownership, when we are saying that I am the owner of the company, when I can say it, when I'm the shareholder of the company. How can I be the shareholder of the company? When I purchase the equity share of the company or when I purchase the preference share of the company. But if I am purchasing debenture of the company, that means I am a creditorship creditor to them. That means I'm providing loan to the company, okay, in need. So let's understand what is meant by preference share, equity share, and debentures. Maybe debentures we will do in the next video. Today we will discuss what is equity share, what is preference share. So here, kinds of ownership securities or shares. So first one is equity share. What is an equity share? See, equity share is just an ordinary share of a company. Okay, like for example, ordinary share, if we say, here it's written that ordinary share is a part of ownership where each member is a fractional owner and initiates the maximum entrepreneurial liability related with a trading concern. This type of shareholder in any organization possesses the right to vote. That means suppose, just understand by a small example, okay? Small example, suppose the company is in need of, let's understand with small numbers as well, is in need of 1,000 rupees. Fine. Now, how they are going to divide this 1,000 rupees into small shares so that it is feasible for every person to purchase it or every investor to purchase it. Suppose one share is 100 rupees. That means how many shares they can provide over there? 10, right? Because 100 rupees is one share price. So, but they need how many money? They need 1,000 rupees. So, 1 into 100, okay, that means 10 into 100 will be 1,000. That means the company is going to issue 10 shares, okay, 10 shares of 100 rupees each so that they can get 1,000 rupees with which they can initiate their operations of the company. Now, if I purchased 2 shares out of that, okay, that means I have invested 200 rupees and I'm getting 2 share of the company. Now I'm the owner, right? Because in their need, I helped them. I didn't ask anything, but I gave my money, I purchased the share. When I'm purchasing the share, that means I am the owner of the company. Okay, so whenever we are purchasing the equity share, first thing is that we get the voting right. Okay, voting right means that we have the right to choose our boards of director over there. Fine. So let's understand the advantages of equity share capital. So equity share does not create a sense of obligation and accountability to pay a rate of dividend that is fixed. See, here, when we are purchasing the equity share, we become the owner, right? When you are the owner, you don't say that I need this much of money, I need that much of money, this much of money you should give me. You're the owner, no? You have to deal with the company. You have to go according to the working of the company, right? So here they don't fix the dividend or pay how much they will give you at advance itself. Definitely you are going to get some kind of return out of the profit that the company makes, but it is decided later on how much. Okay, it's not possible that they are going to give you every year 20% or 10% like that. Okay, it depends upon the profit of the company. It depends how much the company is retaining the money out of the profit and how much they are willing to distribute it as a dividend. Okay, so equity share capital, we can say that it does not make some kind of obligations that the company have to pay this much of money to the shareholders. Okay, it depends on the company's decision how much they want to give or they don't want to give. Okay, even if they don't give, you cannot raise question over there. And the next one is equity share can be circulated even without establishing any extra charges over the asset of an enterprise. Third one is it is a perpetual source of funding and the enterprise has to pay back. Okay. And the last one, equity share are the authentic owner of the enterprise who possesses the voting right. Now, before moving on to the what to say, preference share holders, let's understand the equity shareholders first properly. What are the we can say advantages of it, or how it is more beneficial than the preference shareholders, or is it not good than the preference shareholder, or which one is better? Okay, so see, whenever you are purchasing the equity, that means you become the owner. You cannot ask any kind of dividend until and unless the board decides. But in case of preference shareholder, it's opposite. We will see here. Okay, let's read this preference share first. So preference share are a long-term source of finance for a company. They are neither completely similar to equity nor equivalent to debt. So the law treats them as share, but they have an element of both equity share and debt. For this reason, they are also called hybrid financing instrument. These are also known as preferred stock, preferred share, or only preferred in different parts of the world. So they are various types of preference share used in source of finance. Okay. There are many advantages of preference share. Let's go through this one by one. Then we will understand the difference between the equity and the preference shareholder. So first one is appeal to cautious investor. So preference shares can be easily sold to investors who prefer reasonably safety of their capital and want a regular and fixed return on it. So here comes the part. Here comes the first difference between the equity and the preference shareholder. What happens in preference shareholder is that how much of dividend they are going to pay to preference shareholders are decided beforehand itself, like 10% or 12%, whatever, but it's decided beforehand itself that the preference shareholders will be receiving, suppose for example 12% every year. So that means preference shareholders are the safest part because they are going to get regular income, or we can say fixed return every single year. But it's not so in the case of equity. because equity shareholders, they are the owners, right? When you become the owner, you have to think the company like it's yours only. You don't have to think about more profit, right? Yes or no? So ultimately, the dividend that will be paid to the equity shareholders are not decided beforehand. Okay, it is not decided beforehand, and the amount or the proportion at which the equity share will be getting the dividend is decided by the board of directors. Okay, sometimes you may get it, but sometimes maybe you may not get it. It's not fixed. But if you want your capital to be safe, you want to be in the safe side, then go for preference shareholders, because you are going to get fixed rate of return every year. Next one is no obligation for dividend. So a company is not bound to pay dividend on preference share if the profit in a particular year are insufficient. So it can postpone the dividend in case of cumulative preference share also. No fixed burden is created on its finance. That means, suppose sometimes it may happen that the company may not earn any profit. Okay, so every year it may not be possible for the companies to provide dividend to the preference shareholders, because maybe this year they have faced loss. So what they can do is they can carry forward this year's dividend to next year. So in next year they are going to give return for 2 years in total. Okay, that means the sense is that it's not like that even if you're facing loss, you give me the money. Okay, they will give you, okay, suppose they are facing loss, it's okay, in the next year they will carry forward this year's dividend, and in the next year they will give you 2 years dividend altogether. Next one is no interference. So generally preference share do not carry voting rights. Okay, so they do not interfere in the working of the companies like that. Next one is trading on equity. So the rate of dividend on preference share is fixed. Okay, therefore the rise in its earning, the company can provide the benefits of trading on equity to the equity shareholders. Okay, next one, no charges on asset. So when your preference share do not create any kind of mortgages or charges on the asset of the company, so the company can keep its fixed assets free from raising loans in future. Next one is flexibility. So we can say a company can issue redeemable preference share, okay, for a fixed period, and the capital can be repaid when it is no longer required for the business. So there is no danger of overcapitalization, and the capital structure remains elastic. So here redeemable preference share means that suppose they are going to issue preference share only for a particular period of time, till the time when they need the money. For example, like for 1 year, if they need it, they're going to issue preference share only for 1 year, and after 1 year on its maturity, the company is going to take back the share and give the money back to the investor. So it will help them to avoid overcapitalization, because they don't need it, right? If they don't need it, what they are going to do with that money? And the last one is variety. So different types of preference share can be issued depending on the need of the investor. So participating preference share, convertible preference share, okay, cumulative preference share. There are different kinds of preference share. We will study one by one in the coming videos. Okay, so ultimately what we can understand is that one difference, again, I would like to say, between equity and the preference share is that suppose when the company is going through liquidation or winding up, at that point of time they need to repay all their debts, right? All their debts are to be repaid, but at that point of time there is one advantage for the preference shareholders, that company is going to repay the dividends of preference shareholders first, then only if something is left out they're going to pay to their equity shareholders. Okay, at that case sometimes maybe the equity shareholders may face loss over there. So if they are the owner, they will have to carry that loss anyway. Okay, so that is another advantage of preference shareholder. So I hope this session was fruitful and understandable to you all. We will continue in the next video. We will see different types of what to say, preference share, then again what is debentures. These things we are going to discuss in our coming videos. So thank you so much for this video. Thank you. Stay well.